Hi everyone, it's Faisal here from Sheriff CPA. Well, it's been a pretty interesting year, I want to say, as far as taxes and the stock market is concerned. And several of my friends and clients and family members have bought and sold investments, such as stocks. And today I wanted to discuss capital gains. So there's two things. There's your capital gains rate, and then your capital gains taxable amount. So the amount that you sold your stock for, minus what you purchased it for, and minus any selling expenses, such as if you had any brokerage fees and things like that, that is your net gain. And then if you sold it for less than what you purchased it for, then that's a net loss. So the amount that you pay tax on is the net gain. Now, if you sold if you held on to the stock for under a year, then that's going to be a short-term gain, and you're going to pay tax based off your ordinary tax rate. However, if you held on to it for over a year, then you're looking at paying capital gains on a long-term basis, which is a more favorable and lower tax bracket. So if you've held on to your stock for close to a year, I would advise you to hold on for it for a few more days. So that way it is held for over 1 year, and that way you're within the long-term capital gains tax bracket, which is a more favorable tax rate. So one question that I get asked a lot is, okay, Faisal, how do we lower our capital gains tax? And so there's a couple of different ways that we can help you minimize that tax ethically. And one way would be is that any capital losses that you had can be offset against the capital gains. That's one way. Any excess capital gains that you have, up to $3,000 of those can be of excess losses can be used to offset your ordinary income per year. And the remaining amount of those excess losses can be carried forward on your tax returns in future years. Another very savvy mechanism to ethically minimize your capital gains is to use different vehicles, such as a traditional IRA or a Roth IRA, or possibly a 401k plan, to trade stocks within those accounts. These vehicles can help you actually reduce your income while you're in a higher tax bracket, and also eliminate capital gains as a result of trading in these accounts as well. Lastly, if you are facing high amounts of capital gains, you may want to look into gifting those stocks to family members in lower tax brackets, so that when they are receiving those stocks, then they pay the capital gains based off their own tax rates. So that's another mechanism that you can utilize. Actually, one last tip would be is buying and holding investments. So a lot of investors, buy good index funds that never need to be sold. So they'll just hold on to it forever, and the interest and dividends that it makes are used to purchase other investments. The only downside with this is that your capital gain is kind of locked into that investment, but it's definitely another strategy that you can use. So that was my advice for capital gains, and I hope everyone had a great year. Stay safe. Thank you so much for listening.